Let's talk about Amazon's fourth quarter and full year earnings, Jeff Bezos stepping down, and last but not least, their path for world domination. For the purpose of this video, we're going to focus on full year 2020 results, which Amazon focused on three main areas: net sales, operating income, as well as net income. And these three different areas tell three different stories. Starting off with net sales, you can see that from 2019 all the way to 2020, there was a 38% increase in overall sales. And for a company that had sales of $280 billion in 2019, going up 38% is pretty massive. In the 10K or the financials, you'll find that Amazon breaks their business down into three areas: North America, International, and AWS. Now, all three of these areas grew 30% or more in 2020, but you will see that AWS went from 37% growth to 30%. Now, the law of large numbers essentially says as you get bigger, it is harder to grow that revenue and continually bring 50% growth. At some point, it starts to have diminishing returns. And the reason there's a lot of focus on AWS is because it has higher margins and it's a growth path for Amazon as a whole. And one of the notes that they had for AWS is that most of this increase in sales is due to increased usage from customers, slightly offset by pricing impacts, meaning that they lowered the price, but the usage went up. The second main focus area was operating income, which went from $14.5 billion to $22.9 billion. That type of growth represents a 58% increase year over year. So what's going on there? We have a net sales increase of 38%, but the operating income, essentially how much money they're making from the operations of the business, went up 58%. So there's a disconnect there. And the reason for that is actually AWS. If you look at the breakdown of operating income by area, all three grew year over year, but what is driving the higher percent for operating margin as a whole business is the fact that AWS has added a lot more income in absolute dollars year over year. So the business went from a 5.1% margin overall to 5.9%. AWS is definitely taking that higher because that business actually has an operating margin of close to 30%, where the rest of the business actually has something closer to 4%. So that sales mix or the increase in AWS is bringing up the whole business's operating margin. And I expect that to continue into the future. And the last point is that operating income ended up converting to net income. So from 11.6 billion to 21.3 billion, the year-over-year growth for net income was around 83%, which once again is huge. And you're probably thinking, yeah, everyone knows Amazon's growing super fast. They have been growing super fast. Well, I did do a discounted cash flow model to see what kind of valuation is popping up out of that, as well as kind of compared it with similar companies to see, is the valuation from a metric level or a comparison level, does it make sense? And don't get me wrong, a discounted cash flow model is not perfect because a lot of assumptions are going in. And if you tweak any of these, the valuation definitely changes. So when it comes to discounted cash flow models and you're listening to price targets, you have to make sure that what's being used for the assumptions is reasonable. So some of the big factors here: discount rate of 7.1%. And then the assumption is that by 2025, the margin expansion will get to around 8.5%. And total net sales for Amazon will be $900 billion. Based on those assumptions, the intrinsic value that I calculated for the company is $4,010 per share. When I did this post about a week ago, it was trading around $3,352, whereas today of this filming, Amazon's currently at $3,260, so an even better deal. And then a lot of the time, people will bring up the PE ratio for Amazon because it's relatively high. Now, when you factor in the EPS growth over the next 5 years, it looks a lot more reasonable when you compare it against other big tech companies. So Amazon, the PEG ratio was around 1.23, whereas something like Apple with their growth rate and their PE ratio looks actually worse from a value perspective compared to Amazon when you factor in the growth. Now, Facebook looks even better than Amazon, and it's not by chance that Facebook is one of my larger positions in my portfolio. When it comes to risk with Amazon, I see two things. There's the antitrust regulations, so they're gonna break up this big business, and for one, I don't think they have a monopoly on anything. There's competition in a lot of the areas that they focus on. And then also, if there was a breakup of the company and you were a shareholder, you would get a piece of those new businesses. So if AWS was siphoned off, honestly, I'd be okay with owning that section of Amazon. Honestly, all of the businesses on their own would do well, in my opinion, and it may be worth more split up. So it's not the end of the world. 2, the COVID impact. So if we're talking about a bump in sales for people buying more things online, I don't think that's a short-term effect. I think the transition to online has just been sped up due to COVID, but I don't think just because we go back to some normalcy that all of a sudden Amazon is going to see a huge decrease in sales. I think they're going to hold on to those increased sales as well as market share. So going forward, I don't think COVID will basically have a reversing effect in terms of the financial impacts. Now let's talk about Lord Bezos leaving the company. So we do have Jeff Bezos resigning as the CEO, but he's not necessarily leaving the company and the ongoing decisions forever. Jeff Bezos will be replaced with this guy, Andy Jassy, who's currently the CEO of AWS, or Amazon Web Services. So really, he's been with the company for a long time, and him shifting over to the CEO of the entire company, I think won't have huge effects on Amazon as a whole. And like I said, Jeff Bezos isn't leaving the company entirely, he's just moving to a different role. So as an executive chairman of Amazon's board, he'll still have input on long-term strategy and kind of steer the ship of where he thinks Amazon needs to go to continue to be that innovative company that disrupts markets. So there you have it. That's my opinion on Amazon's latest earnings, as well as Jeff Bezos leaving. I still think the company is a good buy here, even though it's worth trillions of dollars. Their growth is there, their innovation is there, and I think the company will still do well over the long term. So for me, I'm still allocating a higher percentage of my portfolio to the company, and if there's any huge drawbacks, I would be way more aggressive with adding to that position. So for now, my price target is definitely above 4,000 for Amazon, and we'll see where it is in a year or two. Thanks guys for watching, and if you did enjoy this video, please consider giving a thumbs up and subscribing to Main Street Wolf. Thanks again, and have a great day.